Good day, everyone, and welcome. My name is Tim Harty. I'm Mondac's Chief Executive, and today is the second of our exciting Autumn 2022 Future Series events in partnership with Bennett Jones and the Canadian Corporate Counsel Association. I'm thrilled to be able to moderate a terrific duo today with two legal experts joining us from Bennett Jones, Radha Curpen and Stephen Burns. Radha is Bennett Jones Vice Chair, Managing Partner of the Vancouver office, and National Leader ESG Strategy and Solutions. Radha has over 30 years of legal and advisory experience and specializes in providing strategic counsel to clients related to the environment, First Nations, wider ESG matters, gender equity issues, and hazardous material matters. Radha is recognized as a leading authority and a top lawyer in Canada and the United States in her areas of specialty, and regularly advises corporations, boards, committees, First Nations and governmental agencies across Canada and around the world on strategies, best practices, negotiations, and litigation. Stephen is a partner and trademark agent at Bennett Jones and co-head of the Innovation, Technology, and Branding Practice Group. His practice focuses on energy, utility, and infrastructure-related technology, procurement and outsourcing, technology transfers, intellectual property, mergers and acquisitions, and corporate commercial matters related to technology. Stephen has extensive IT procurement-related experience. He has led a number of large, multi-stage, multi-vendor outsourcing transactions on behalf of large integrated energy companies and utilities, and clients in health, financial markets, and banking. Stephen is regularly retained by clients for IT procurement, RFP and contract negotiation matters, including development, customization, co-location, and cloud services. I'm delighted to say that Radha and Stephen are our future series speakers today on managing the risks of ESG reporting and compliance for in-house counsel and executives. Thank you very much for joining us. We have a fantastic audience from North America and the wider globe, so thank you for joining us today. Before we get started, just to say that you'll have the opportunity to submit questions to today's presenters by typing them into the questions pane of the control panel. Please send your questions privately to the organizers only. We'll address as many as possible during the Q&A session towards the end of today's webinar. Right, I'd like to get today's discussion off to start, beginning with Radha. Radha, to help everyone level set, please share with us the importance of ESG and ESG reporting. Thank you.
Thank you. Thank you, Tim. Thank you for having us. Thank you, everyone, for being here. I always start this discussion with ESG, so I apologize if you've heard me say this before, but ESG, which stands for Environmental Social Governance, has been on a rapid rise in prominence in the past few years. So it's not a new concept. We all know that organizations have been factoring some ESG-related considerations into decision-making for years. We also know that the legal framework in many jurisdictions, including Canada, supports decision-making processes by corporate directors that consider impacts to stakeholders beyond just the shareholders. So based on a broader view of what is in the best interest of the corporation. So ESG is a term used to assess an organization's behavior, evaluate its performance based on those 21st century risks and opportunities. That's what this is. So what is new is that the momentum and demand for ESG information and performance by organizations is rapidly accelerating. It started as an investor phenomenon. It was coined by investors. ESG is a term that was coined by investors. It has now grown into rights holders such as Indigenous communities in Canada, stakeholders across the board, including employees, customers, regulators, suppliers, and others, are all looking to evaluate organizations based on ESG performance. So we're seeing greater demands from rights holders and stakeholders to understand the implications of ESG and how it is being considered and implemented by companies. organizations as well as regulators. Organizations, including regulators, are all grappling with how ESG risk and opportunities affect their own activities, how it impacts their sustainability, and how it impacts their mandate, both over the short term and long term. The key is that ESG is very broad. It's not a specific list of issues. It is something that will continue to evolve to reflect the concerns and issues and the risk and opportunities of the day. So ESG today is going to look different from what it looks, the ESG in the future is going to look different from what it looks like today. Here's some examples so that I want to sort of make sure that everybody's on the same page when we talk about examples of ESG issues other than climate change. Relationship with Indigenous communities. In Canada, it's the implementation of the United Nations Declaration on the Rights of Indigenous People, UNDRIP, and its potential broad implications in all areas of law and many facets of our economy. Board diversity, in addition to EDI broadly, executive compensation that is now looking to be tied to ESG, cybersecurity, anti-corruption, modern slavery, supply chain issues and ESG in the supply chain, the war in Ukraine, energy security, food security, water scarcity are all issues that may have a different impact or priority for different organizations depending on what they do and where they do it. So one of the concerns that exists in relation to the growth of ESG information in the marketplace is whether corporate reporting or other forms of ESG communications with stakeholders is potentially untrue or misleading or incomplete or presented in a manner to try to convince stakeholders of attributes that are not there and what are sometimes referred to as greenwashing. This is a significant concern for ESG information, given the amount of information that is produced on ESG in any organization and how it is being evaluated and used by different organizations. Who are your audience? What are the goals? How do we ensure that the information being put into the public sphere is accurate, it's comprehensive, as well as comprehensible, and what controls might be needed to protect the public from misinformation in that space? So there have been many calls for more standardization of how ESG information is disclosed in an effort to provide more standardized or consistent ESG communication so that stakeholders can understand the information and understand how ESG has been considered in a given context. So this leads to the confusion around ESG, the standards, the reporting agencies, the task forces created to develop consistent disclosures. Who do we listen to? Which standard do we adopt? There's a plethora of information that stems from the fact that ESG is so complicated. But even just look at the list of the examples I give you. And there's also a recognition that it is sometimes difficult to measure, compare, and benchmark ESG performance. How do you measure your meaningful relationship with communities? How do you compare it? How do you compare a natural resource company and a renewable energy company? Those kind of things. So we do need to understand that there are many laws that are related to ESG, and ESG reporting and communication is a mix of voluntary initiatives, business requirements, as well as mandatory disclosure requirements. So it's important to ensure that an organization's data and narrative is accurate and consistent across the board, regardless of why or how it is being reported. So the goal of ESG reporting is to communicate to the audience what your ESG narrative is, what your priorities or commitments and how you are performing on those. Some of the challenges are that there are likely many material ESG matters on a number of topics for an organization. There's a diversity of standards and there's concern about greenwashing. All of these pose legal risks for the organization. And I just want to flag for this audience, the ESG reporting frameworks we're seeing across industries are rapidly evolving. It is important to be aware of these changes so that you proactively work to adapt. And here are some highlights that I want to include. So TCFD, the Task Force on Climate-Related Financial Disclosure, is one of many reporting frameworks that we see used across industries in ESG reports. Other prominent frameworks include the United Nations Sustainable Development Goals, UN SDGs, GRI, which is the Global Reporting Initiative, SASB, Sustainable Accounting Standards Board. So TCFD includes recommendations for public companies to report on governance, on strategy, on risk management, and metrics and targets. And at this point, TCFD is a voluntary reporting framework that many organizations across industries opt to follow and to into their ESG reports. There's new development. The Canadian Securities Administrators proposed guidance also closely follows TCFD requirements. Similarly, in the US, the SEC proposed a rule requiring public companies to report on climate-related financial risk on TCFD. I can go on about International Sustainability Standards Board, etc., which I won't do right now because I'm limited in time. So what I will say, let me end this part by saying the guidance from securities regulators has made it clear that reporting issuers must consider ESG factors as part of the information of what must be disclosed from a compliance perspective on the basis of materiality and the existing regulatory requirements, whether or not there's already existing regulatory requirements. I'm going to end this here, Stephen.
Thank you, Radha. That's very clear. Clearly a lot going on in that space. Right, Radha, from an environmental or regulatory point of view, what are some ESG reporting risks?
In terms of regulatory ESG related risk, there's various regulatory schemes. That's the first risk, is that so in Canada, the ESG regulatory framework consists of numerous statutes, regulations, and policy directives from all levels of government relating to ESG related considerations. So you'll have departments, ministries, agencies, professional governance, regulatory bodies, among others. You have statutes that form the ESG framework in Canada that generally include an enforcement regime that provides for prosecution, fines, penalties, other enforcement mechanism, administrative orders in connection with a breach of obligation. When I talk about these statutes, I talk about statutes that exist in securities law, corporate law, areas that are related to subject matters such as environmental, occupational health and safety, employment, pension regulation, to name a few. So that's what I'm talking about when I'm talking about ESG related. So while the legal ESG related requirements may currently be spread out across different legislation and provisions, and many may not even be characterized as ESG requirements, when we look at it with an ESG lens, you see the ESG relation. But the importance of robust ESG reporting is rising. So robust ESG reporting can help an organization manage its mandatory reporting requirements and to have one umbrella under which different regulatory reporting requirements can be addressed. So I think what is important to remember, whether it is mandatory or voluntary, it must be carefully reviewed and challenged for accuracy and consistency. And a lot of time, a lot of people are doing things in organizations at different operational level, reporting on environmental and other things that may not even be looked by or considered by the legal department. It's very important to have a rigor in front of this, especially in the age of ESG. So inaccuracies, misinformation, or misleading information can not only form the basis of reputational harm to the company, but also basis of legal claims and potentially regulatory violations. So it's important that what ESG reporting to me is not just the ESG reports, it's a lot more than that. We treat it with a high degree of scrutiny. So in the environmental and regulatory realms, the increase in mandatory ESG reporting is leading to a rise in ESG litigation. This is something to be aware of, as ESG litigation can stem from failure to meet mandatory reporting requirements and also be initiated by stakeholders who are not satisfied with an organization's ESG commitments and as promoted through their ESG reporting. So litigation can arise out of, one, a perceived failure by organizations to include an adequate response to ESG matters in their public disclosure, two, inconsistent disclosure or the failure to inform stakeholders of ESG matters that are viewed by such stakeholders as material to business operation, and inconsistent disclosure of the failure to inform stakeholders of ESG matters that are viewed by such stakeholders as material to business operation. So this could be either government suits against companies that do not meet requirements. It could take the shape of shareholder activism and derivative actions by shareholders who are pushing their companies to take stronger ESG stances. There will also likely be litigation against government and regulators by companies and anti-ESG activism groups. Let's see where that takes us. There's litigation by climate and other ESG activist groups against organizations and governments for not doing enough on ESG. So we can expect this type of litigation to continue to grow. So let me end on a few cautions. Companies should be careful when publishing environmental commitments or goals. These goals must be reasonable, achievable, demonstrable. We often get questions from organizations, from companies, this is happening in the world, this is a new event. Should we make any commitment or should we say something? We always say pause, think about the implications of what you're going to be saying and what does it mean for you? What will you do? And if there is no need to say anything, don't say anything. Sometimes it's that. The second thing is data management is essential. So ESG data is collected, published through many different means. And when we start with talking to organizations, it's amazing the plethora of data that's available that may not be considered by ESG people at the beginning as ESG, but it is. So companies must have in place sophisticated data management systems, including programs to ensure accurate, consistent, verifiable across various disclosures. Third, let me end by saying litigation will be used as a strategy to highlight and challenge the inconsistency between an organization's ESG-related obligations and commitments and with an organization's actions. So that is being considered in many by many outside of organizations. So I want to end that with that caution.
Oh, well, that's very helpful. I mean, it does sound like these sort of ESG litigation risks are potentially being dialed up. So thank you for highlighting those areas to our viewers today. Radha, there's a lot of conversation around reporting and disclosure. Are there specifically securities and financial risks? If you could just help us understand this here a little more, thank you.
Well, there's absolutely risk across the securities and financial sectors. A lot of time people think of ESG as climate change, and it is. It includes that and the regulatory processes. It touches upon a variety of factors. So in the context of securities law, regulators have been focused on ensuring that reporting issuers provide investors and the public with disclosure that is not false or misleading, right? Securities regulators have made it clear that ESG-related disclosure will be subject to increased scrutiny for compliance with securities law requirements. So in 2021, both the British Columbia Securities Commission and the Ontario Securities Commission commenced a green sweep of registrants such as investment fund managers, which were identified as participants in ESG investing, to monitor their compliance with securities laws and ensure that their disclosure in marketing materials for ESG products is consistent with their investment portfolios. This is part of a larger move to address greenwashing in corporate and financial sectors. Other regulators in Canada have scrutinized misleading or claims by businesses relating to their business or products in relation to ESG factors. These referred to as greenwashing may violate other requirements under statutes such as the Competition Act, Consumer Packaging and Labeling Act, the Textile Labeling Act, the Trademarks Act. Those are just examples of the kind of things you might say. So in terms of ESG reporting, there are some additional updates in regards to reporting frameworks specific to securities financial regulator. In January 2022, we have the Canadian Securities Administrators published a staff notice related to ESG-related investment fund disclosure. Again, this notice provides guidance for investment funds on their disclosure practices that relate to ESG consideration. And then, so I won't go into that in detail except because of time. Since February of this year, there has been updated guidelines on mandatory diversity disclosure regarding designated groups for federally incorporated public companies. So these updated guidelines provide additional information after a review of the past 2 years of disclosure since the release of the diversity disclosure requirements. So this is in addition to the Canadian Business Corporations Act's existing mandatory reporting requirements on the representation of women, Aboriginal persons, persons with disabilities, and members of visible minorities. The other thing, in April, Canada's federal budget included a promise to bring mandatory climate-related reporting requirements to federally regulated banks and insurance companies. The government outlined its plan to require federally regulated financial institutions to begin reporting on climate-related financial risk in accordance with the TCFD framework. So this new CSA guidance will add to mandatory ESG reporting requirements and is meant to require public companies to report on the climate-related financial risk. Lastly, in May, the Office of the Superintendent of Financial Institutions, OFSI, issued draft guideline climate risk management for stakeholder feedback on OFSI's expectations for climate-related governance, risk management, and disclosure practice for federally regulated financial institutions. As you can see, lots of things are happening. So let me conclude. To conclude, I would say this: mandatory disclosures and voluntary disclosures that may not have had the same rigor as mandatory disclosures, combined with their escalating scrutiny on greenwashing, present litigation risks for organizations. I am more concerned about the voluntary disclosures that's been made in the past and continue to be made by organizations than the mandatory ones, because the mandatory ones have some rigor behind it, and the voluntary one are beginning to have rigor, but it is very important. So let me finish that there. Thank you.
All right, super. Thank you very much, Radha. Beware the voluntary. Yes, so Stephen, we're going to shift gears a little to information regulation and privacy as it relates to ESG. So I think most of our viewers today know that information regulation is complex and varied. From a privacy point of view, what aspects should we understand? And further, how does it relate to the evolving role of ESG? Thank you.
Thanks, Tim. And if we can go to the next slide. And thanks, Radha. That was a great lead-in. It's, as Radha's just sort of walked us through and explained, there's a significant focus and an increasing focus on the availability, the reliability, the integrity of the data that we are reporting either on a voluntary or on a mandatory basis. We're seeing a lot of regulators and governments be interested in what is this ESG data, how is it coming forward, can the people, the consumers of that information rely on it, how do we protect them in that reliance relationship, how do we ensure that we're not seeing unreasonable market manipulation, we're not seeing untruths, we're not seeing reporting that is misleading. And in the slide that I have up here is a slide that was created a number of years ago to explain the complex regulation of information in Canada, both in the public sector and the private sector. And I didn't bring it up so that we would walk through each and every element of it. It's the slides are here to provide a resource. It's there to highlight a couple of things that are occurring. So all of this information that the organization is bringing forward and thinking about in terms of how they're going to collect it, how they're going to use it, how they're going to disclose it, because ultimately ESG reporting is about disclosures, has an intersection back with privacy. And we're using privacy as an example of that sort of changing face of law, and where what we've thought and what we understood in the last 5 or 10 years, 20 years of privacy in Canada as being a sort of a more sort of level playing field. We sort of understood the law, and we were able to design our organizational processes and responses around it. That's changing. So there's three laws of interest that I want to flag that have come out this year. In British Columbia, they have adopted they've brought forward into the legislature a bill called the Anti-Racism Data Act. And the purpose of the Anti-Racism Data Act is to go through and create data sets within the British Columbia public sector and begin to look for an outcomes-based measure of whether or not there is systemic racism within government services. That is a colossal change in how governments view data and how governments will use data. And I flag it as an example of the serious investment that's coming in Canada towards really understanding data sets and aligning those data sets and outcomes to ESG outcomes. That's a social outcome of looking to remove systemic racism, but it is an important piece of legislation because it's going to have huge impacts on organizations providing services to the public sector in British Columbia as they have to align their data activities to meet these new requirements. The other two pieces of legislation are at the federal level, and we're going to focus on one of them. But the two pieces of legislation are the Artificial Intelligence and Data Act and the Consumer Privacy Protection Act, which will be the replacement for the Personal Information Protection Electronic Documents Act, or affectionately known as PIPEDA, or simply Canada's private sector privacy legislation at the federal level. Those are new pieces of legislation. ADA, the AI Act, is an entirely new area of regulatory control or regulation coming from the federal government, looking to ensure that, as I jokingly describe it, we don't accidentally create Skynet in Canada. And on the CPPA, it's an interesting discussion about risk and about the changes that are coming in Canada as we react to how our global trading partners are addressing privacy, but also how we are reacting to the financial constraints in our government. And so we'll talk about CPPA here in a moment. I think that to sort of answer the question is, if we have all of these information requirements, we have to first decide what all those information requirements are, and then we have to parse through, once we understand them, how our systems and our regulatory requirements are going to drive what we can and cannot do. You don't want to go out to market with a statement that you are going to have a certain level of diversity within your organization if you don't have the abilities to legally collect that information and disclose it how you intend.
Thank you, very much, Stephen. So digging into Canada's Consumer Privacy Protection Act, how is the CPPA changing the game, and are there any specific examples you could walk us through? Thank you, Stephen.
Absolutely. So let's go to the next slide. And again, the slides will be available, and they're there as resources, not as I'm going to horribly try and read all of that busyness on a slide. It's one of the things I always find in a presentation is it's helpful if there's some materials to go back to so you can put together the conversation and that piece. So let's talk a little bit about how Canada, a population of about 40 million people. We are a G7 nation, but I like to joke that both California and Texas have a better right to be a member of the G7 for their individual state economies than for Canada's alone. We are a very large geography, a very small number of people, and we are and want to be a trusted trading partner with many organizations and many other countries in the world. So our reactions to privacy are driven in part by how our trading partners are developing. And without going into a lot of detail, the European Union, of course, had the EU Privacy Directive, and most recently GDPR, and other trading partners around the world are adapting to and meeting those higher standards that are starting to come along here as a result of GDPR. And we're very concerned as Canadians that we had the benefit when the EU directive first came live that our Personal Information Protection Electronic Documents Act was found to be sufficient to enable the free movement of personal information back and forth between Europe and Canada. And that's a very important trading partner for us. And it's very important, given the strength of our financial systems, the strengths of a number of our operational businesses, that we're able to have that free flow of information. When our trading partners bring their privacy standards to the next level, because that's what the world is moving towards, then there's an automatic movement, or there needs to be an automatic movement by Canada to stay pace, or risk losing our favored information flow. So part of the CPPA is that we are looking at bringing our federal legislation up to that level so that we maintain our preferred trading position. And then you'll see as well at the provincial level in Canada, where we have privacy laws in Alberta, British Columbia, and Quebec, you're seeing reviews and modifications that will see those legislation come up as well. So there's change coming. And that change will align between our jurisdictions, but we should also know that Canada's approach in some issues is materially different than what we see. It's not just a carbon copy approach between us and Europe. And in fact, in some areas, we're the more stringent jurisdiction. But let's go to the next slide, because I want to talk about what was just a very interesting news item and why I also think we're seeing changes, and it really ties us back to the risk discussion. So the first risk is we're changing our laws because we want to ensure that our global trading partners will continue to be our global trading partners. The second one is Canada's losing out on the privacy violation world. And about 6-7 days ago, there was a really interesting development in Australia. Australia had one of their one of their telecommunications enterprises had a material breach of their security. And it's reported that something like 38% of the entire population of Australia's personal information was exposed through the breach. As a result, the Australian government is announcing that they're looking at a rapid set of changes to their private sector privacy legislation to bring in some really significant fines, and so that they are capable of participating in what I'm calling the privacy tax. And what I mean by that is, if you look at some of the European Union privacy breaches, you're seeing really significant fines. You're seeing the GDPR is based on a minimum and then a percentage of global revenues, and you're seeing fines in the hundreds of millions of euros. And it's important to remember in this day where we're in the next version, COVID 2.0, whatever we're going to call the next phase we're going into, where governments have had extensive funding, extensive expenses, and they're looking for new revenue sources. And when you leverage a fine, that fine often comes back into the government as general revenue. And so this slide highlights that under the CPPA, we're going from a federal privacy regime in Canada that had very little power and very few dollars at risk into minimum penalties of the higher of 10 million or 3% of gross global revenue. If it's an intentional offense, an indictable offense, you're up to 25 million or 5% of your gross revenue. That's a really big change. And it's in part because, and you saw this in the commentary in Australia, not all the global jurisdictions have significant fines. And with the European Union being successful in obtaining settlements for large privacy breaches, we're seeing a real movement by government to say, hey, I can get some cash out of against organizations with very little global footprint in my actual jurisdiction, but a big impact to my citizens, which means I can have a form of taxation without having an actual input or direct taxation against my own citizens. So it's a perspective, but it's one I want to highlight, that ESG is fascinating because all of these requirements for data that we've never really had to design or put forward. And now I have organizations who are trying to figure out how they update their management information systems to get that robust data stream. And they better be making sure they understand what that means from not only a compliance to their regulator for the delivery of that information, but also how they collect, use, and disclose it, and things like privacy. So let's go to the next slide. And let's talk a little bit about what else is in the CPPA. And this is just a high overview. It's a complicated new piece of legislation, but there's a couple of pieces I want to flag, which is we are, for the first time in Canada, we've had a pretty lackadaisical approach to the level and rigor of documentation that you had to put behind your privacy compliance program. And now we're seeing that the federal government's introducing a specific obligation to have a privacy management program, but more importantly is to document it. And they've added additional rights where they don't have to have a breach, they don't have to have an issue. They can ask for your privacy management program materials. They can conduct an audit to see whether or not they are comfortable. They can give you recommendations. And if you fail to follow those recommendations as proposed, they'll be able to fine you. So let's go to the next slide. Safeguards. We are becoming more and more focused on the safeguarding of information. So with all this ESG information, and this is more on the social governance side than necessarily the environmental side, but in the privacy space where you're collecting this information, you're to be able to meet your ESG aspirations, your ESG goals and reporting obligations, you're going to have to collect a lot more personal information, just here in the context of this privacy. And the standard of security is it's increasing, and the safeguard obligation is increasing. So you've got a higher fine, you've got a program where you have to now document what you're doing, and you're having higher actual obligations such as around security. And what's important about the obligation around security is it's not just your security within the four square corners of your organization, it's the security of all information within your custody and control, which means you are responsible statutorily in Canada for the compliance of your service provider, which means you're also statutorily liable in Canada for their safeguarding of your information. So the diligence this is going to force upon Canadian organizations to connect with all of their partners that make up their information networks is not insignificant. And I want to highlight that in the risk area of bigger fines, more documentation, and more responsibilities. So if we go to the next slide, this is that service provider point where I want to flag that we're responsible for what our service providers do, but also, which is interesting, in Canada, we hold our service providers directly responsible under the legislation as well. So if you are an organization that's providing services to others and you're managing, processing the personal information of others, you should know that elements like safeguards apply not only to your controller, the party that you're providing services to, but you as processor, to use the European language. And that has been clarified. So that's been the law in a number of the provinces for many years now. But it's being clarified that that safeguard obligation actually extends through to the service provider. So this whole ecosystem of the entities that come together to manage this information and bring it forward to meet your regulatory requirements, to Radha's point, you're being exposed on the disclosure side because you're accountable for that information being accurate, available, appropriate for what you're trying to disclose with it. You're not misleading, but you're also going to be responsible for the systems in place that are going to drive that data. Let's go to the next slide, please. And then I think it's important to highlight that we're adding some new rights in Canada through the legislation, which will create some new risks. We're going to add the ability to have data portability. The regulations aren't out yet, so we don't know exactly what this is going to mean, but it essentially means that a financial institution, we believe, will have an obligation to transfer information to another financial institution so that your personal information will still be available to you, that you're not going to be tied to one company because of your history. Your history will move with you. That's an entirely new framework that will have to be considered about. How does that data move? How do you ensure that you validated that the request is there? How do you ensure that you're capable of doing it? It's a completely new system that's coming. It creates a whole series of risks and new processes that will need to be considered by organizations. That's a good one to flag for risks coming in this changing law. The right of disposal will come into Canada, that you have the right to request disposal, and a lot of systems are just antiquated and don't have the capability to delete out individual records. And to Radha's point about if you've got people disposing of records, so your data set is changing, how do you ensure that you're reporting properly on your comparisons and otherwise going forward for your disclosures in your ESG regulatory environment? So there's an interesting element there as you're trying to balance these competing rights. And finally, as we all know in the technology space, it's all about automation. You want to do it once right. You want to set a fair and reasonable system, and then you want to make sure that system is operating. Now you're going to be exposed, and we'll have to discuss how decisions were made using an automated system. So, as a quick example, you're in the business of you have 8,000, 10,000 employees. You have a certain amount of employee turnover, so you're always looking for good candidates. And oftentimes you'd be looking for good candidates through online resume portals, right? You're posting onto X or Y.com, and X or Y.com are looking at your job, and they're looking at their bank of thousands and thousands of applicants, and they're not manually searching that bank. They're using automated decision making to review and begin to match candidates that meet your requirements off of their algorithms, which is why they're competing in the market saying my algorithm is better. From an ESG point of view, you want to make sure that you're meeting your diversity, you're meeting your statements that you're making about honest hiring practices, blind hiring practices, that you are hiring on the basis of merit, you're not hiring on the basis of grounds, you're not discriminating against people. Now you will be responsible, because you're responsible for the actions of your service providers, for what that website is doing in making those decisions about how to bring people forward to you. It's created a whole new microverse of diligence and understanding, where honestly the HR team doesn't have the skill set to be able to understand how an AI system may or may not be learning discriminatory practices as it brings forward information. And in some instances, in some jurisdictions like New York, you're finding that there's new disclosure requirements around automated decisions. This isn't a Canadian-only experience. New York City issued some strong guidance on that recently. So to sort of wrap on this point, you've got all of these developing disclosure requirements. You've got systems that are struggling and working to be able to deliver on those disclosure requirements and meet them. And you've got laws which your systems were designed to meet that were created 20 years ago based on a trading environment in the late 90s, the dot-com era, which is now rapidly changing both from a global perspective and a local perspective as various organizations look to participate and frankly look to make some money, which means the risk of privacy is going to get much, much higher. A long-winded answer for you, Tim.
All right, thank you very, very much, Stephen. I mean, and obviously for all of us on here today, clearly heightened privacy standards and obligations as it relates to ESG reporting, something for us to all watch very carefully. Shifting gears slightly, Stephen, to ESG transformation organizations. How do reporting risks specifically impact ESG transformation in your view?
Okay, so let's sort of go to our next slide and talk about the how do I do this, right? So we've talked about risks at the disclosure level, we've talked about risks in the process level, and now practically, what am I doing? So I pulled this slide together just as a simple reminder that you know, compliance isn't an event, it's a process. Compliance is, especially in a changing, evolving world, it's about the resiliency of your process and your resiliency of the ability to manage change within the organization that enables the organization to be able to continually identify, react, and meet its needs in its regulatory space, in its financial market space, in its stakeholder space. So collect that ESG information, deliver it out in the right packets, in the right model, where you have those internal controls that it's coming through cleanly. So that's both, you know, the way we have internal controls and financial controls around our audited financial statements, around our internal audit processes. You're developing new internal controls. And you're also at the same time looking at how do I do proper change management, because my legislation around what tools I can use and how I can actually deliver on this are changing, as I've just highlighted in my slightly deep dive into CPPA, but you can't blame a privacy lawyer for getting excited when he gets a chance to talk about privacy. What we're talking about is approach to compliance. And that approach to compliance really comes down to those 6 or 7 key elements that gives you an ability to put in place a robust compliance change management program. And the first and foremost one is you've got to have a champion, right? The board is making decisions around what ESG targets are going to make. The executive leadership team, the CEO and that level is making decisions around how they're going to give life to those board directives and how they're going to meet those market elements. And then you need within the organization that person who is going to champion change, because you're in a world of competing resources and competing projects, and you've got to make sure this one stays on top. You really do need to focus on scope. There's a lot of scope creep in these projects, which will then kill them. You really need to be targeted on what it is I'm trying to achieve and take it into manageable pieces. If you try and boil the ocean, you're going to get nowhere. If you're trying to boil water for a single cup of tea, you'll have a cup of tea. So let's focus on what that clear scope and governance is and stay focused there. You do need to identify what the issues are, the internal environmental scan. Radha and I have just given you a very high level scan of some of the issues. That'll have to be targeted back to your actual organization. And then you get into the real part, which is assessment, implementation of change. That's where the rubber hits the road. That's all project. That's all having the right people always in the process of looking at ESG compliance as a process, looking at staying on top of all these changing laws. Since we last talked, those 3 pieces of legislation came out that I mentioned, and I'm expecting more quickly. This is a rapidly changing area where you do need to continually identify, assess, and then implement changes. Finally, document. because for litigation, it's documentation is going to save you, not what I recalled, but what I did. And please, the impassioned plea from a lawyer is be mindful and thoughtful in how you document. There is nothing worse than quips and personal bias comments in documents. I don't care what you think about somebody else. Please never put it into your documentation, which is just a live story from something I'm working on from 2 weeks ago when I just was floored by some of the personal commentary that made it into the margin notes of a document. It's now getting disclosed. I cannot warn everyone enough of that. And then you've got to put through your training and audit. You need to update your systems to make sure that you are fully supporting that this is a process, it's not an event, and it's something which is now going to be part of your day-to-day life. You need to accept that this is coming in and it probably is going to report into your risk and audit committee, right? Your internal auditors are going to have those internal controls on ESG governance now. Anyway, that's a simple approach. Also, I just kind of love the graphics, so the nerd in me had to come out and share the graphic.
All right, thank you, Stephen. A great slide and also some sage advice. One more question that I'm going to put to Stephen, then we're going to open it up to Q&A for about 10 minutes. We've had a couple in already, so feel free to send questions to us. But before we get to that, Stephen, what are the next steps organizations should be taking in this area?
So besides my sort of approach to compliance, I think the initial step is pause, calmly decide on who's going to be the champion, and scope the first internal and environmental scan. Collect your information, start to get together the team, and then begin to roll through that process. And then really, it's remember the internal expertise that you have. If we drop to the next slide, I just want to close out on that sort of question about where is this change and who sits at the center, who's there. There's a whole bunch of changes going on. You've got ESG objectives, you've got changing in reporting, you've got changing law. I spent 10, 15 minutes talking about that. And you have information systems that themselves are changing. And in my view, but I'm a technology lawyer, this really is at the C-suite. This is very much a champion at the board and at the CEO level, but the change in the organization outside of establishing the goals, the physical hard systems changes probably sits with the CIO, but each organization will have to decide who's in the center of that. I have a natural bias that it should go towards the CIO as a tech lawyer, but each organization will find its own spot. It's identify that champion, support them, and let them get going.
All right, that's helpful. And we have a number of senior in-house counsel and senior executives on the webinar today, and positioning the importance of the role of the CIO is very helpful. So bear that in mind, folks. Okay, we've had a couple of questions in so far. Firstly, thank you very much, Rod and Steve. And Stephen, that was excellent. 2 questions. I'm going to put them initially to you, Radha, and then Stephen, if you want to build on Radha's response, please feel free to. So first question from the audience. How does a publicly traded corporation balance transparency and not disclose non-public material information? Radha.
Oh, I think Radha's muted.
Yeah, we'll take care of that.
Okay, I just, okay, thank you. I wanted to say one thing before I answer that question, Stephen. When you talk about CIO, you mean Chief Information Officer as opposed to Chief Investment Officer or anything like that?
Absolutely, absolutely. Thanks for the
that's fine. So on this question, Tim, we have to remember a public company has an obligation to disclose all material information regarding their business and affairs in a timely way. So I'm not sure what we're trying to say when they say non-public material information. If it is a material, it must be disclosed. So there is no real balance between transparency and non-disclosure. So if the question is referring to voluntary disclosure, the guiding principle, material information required to be disclosed under securities laws must be disclosed in regulatory filings. So it is not sufficient for this information to be contained in voluntary disclosure. So we should ensure that the materiality of information contained in any voluntary disclosure is assessed, and if it is material, it must be disclosed in the issuer's regulatory filings, right? If it's material from a perspective of an investor. So voluntary disclosure should be consistent with the information included in a public company's continuous disclosure filing. So that's sort of how I would answer that question.
Thank you, Radha. Anything you'd like to add, Stephen?
That was excellent. Thank you, Radha.
Okay, super. Next question in from the audience. Again, I'll put it to you first, Radha. What profession and course certification are the best ones to manage ESG reporting risk?
So I don't think there's any course certification to manage ESG risk. I mean, I'm a lecturer at the Osgood Certificate in ESG Law. I don't think going to that, attending that is useful in terms of understanding what's going on in the world and the laws and all of that. But it's certainly not for the purpose of like, because of this, then now you can certify ESG risk. What I do want to say is that there are many ESG professionals. They are lawyers, they are accountants, they are other consultants with ESG expertise. What I do want to say is that what we've found to be useful in when clients reach out to us is we work with all these professionals because everyone has something to add. And so we're not going to do a financial materiality assessment, lawyers. We're going to get accountants in on it. We get sometimes the consultants to go in and dig certain things or do interviews. We may be the ones preparing the questions for not a financial materiality assessment, but a materiality assessment of interviews of internal and external stakeholders. Sometimes we conduct them, sometimes we have others with us while we do it, sometimes it's done internally. But what's very important is there has to be a legal lens on this. Internal legal lens, external legal lens, however, the legal lens has to come in. What we found is we work with a lot of in-house counsel to sort of suggest what things we're seeing in other organizations and what are we seeing in across industry sectors, because it's about industry, it's about client, it's about location, it's about substance behind ESG. What does ESG mean? There is substantial law behind those words in different areas of expertise. So that has to be brought in, not just an ESG consultant looking at it. So I hope that answers that question.
I might just add a piece in there, which is in a world full of change, especially one when you're looking at how to manage the change, making decisions about how you will mitigate and address the risks coming from that change. I remind all of our friends and the organizations to always remember the role of privilege in protecting the discussions where choices are being made about how you're going to proceed with reporting or otherwise, or how you're going to interpret and understand the changing law. And it's one where, especially in the world of where documentation will be required and brought forward, if you're making choices and those choices have differing risk patterns to it, you need to always remember that role of privilege. I'll just put that out there.
Yeah, and I would say I don't know, Stephen, whether you said that because sorry, I was distracted by an email I just got. But in case in case you said it, let me say one more thing is that some of the discussion there should be an attempt to protect them. So I don't know whether you covered that, but there should be an attempt to protect them. The only protection that is worth considering is solicitor-client privilege. And some of the data, of course, the data that is obtained for the purpose of obtaining data is not going to be privileged if tested. The discussions around them, if it's done for the purpose of obtaining legal advice, and that should be made more clearly that it is for the purpose of obtaining legal advice. And please don't put everything privileged and confidential, because then it becomes a problem. But I've certainly seen it in terms of an investigation where I've sat with investigators and going through a database of information where I basically say, this is privileged. And it says it's privileged, and I said if we're going to argue about that, we can argue about that in court or with a lawyer on the other side. Let's put it all in a document, in a folder that is bound and marked privileged and confidential. And the investigators, the first line of investigators, they're okay with that. They're not going to argue about privilege. So at least you sometimes, what I found in those investigations, you've often won at that stage because of the fact that they are going to choose on some grounds, choose their battle, and we all do. And so we're not going to go there if we can deal with it in some other way. So as opposed to challenging it, there's situations where it's challenged. So that's why I'm saying you try to protect, because some of it, and do it in a way that there's a rigor behind it too, as to what is privilege and what is not. But so if you are having discussions, so we've got discussions happening with involving an ESG consultant, for example, or an accountant, and we say their work product is privileged, is part of our work product in giving advice to the client. It's the client's privilege, and they're not to disclose, and they're supposed to mark it as such. Even if it's their work product. So it is the product that we're using for the purpose of obtaining legal advice, of providing legal advice. So those are the kind of, there's a lot of things that we do to make sure that that happens. And we would want to make sure that those discussions are protected. So thank you, Stephen, if you raised it and I was distracted. Sorry about that.
Thanks, Radha. Thanks, Stephen. There's one question that's come through. I'll take it off the screen. Last one that we have time for, and I would like to pose it to Stephen because it relates to the model that you presented. Would the Chief Information Officer be expected to take on the role as champion?
Oh, it's a great question, and it's one which depends on the dynamic within the organization. Sometimes the CIO is a powerful individual within the organization, and they are trusted and respected and have the ability to bring people along and understand the importance of the project. And sometimes the CIO is a glorified librarian who is generally ignored and tucked into a corner, and that's not the power dynamic within the organization. And I think that's why I didn't say who the champion was on the slide, because it really depends on the right dynamic within the organization. It has to be sufficient seniority that people understand it is valued and valuable.
Radha,
I want to thank you. So I agree completely with what Stephen says on the Chief Information Officer. I do want to say this requires a number of champions of change. So I want to make that clear. It's not just the Chief Information Officer is there to manage information, and the directions will come from different places. And so I think that the chief legal officer has a lot. The general counsel is definitely a champion. So is the CEO. So is the CFO, and investor relations have their own say into it, and of course the board, and will be overseeing things. But there is usually an audit committee or ESG committee, environmental committee. All these various committees of the board will have things. So I would view champions of change on ESG and sponsoring coming from different roles within the organization. Just like we have, I call them, Stephen knows, Stephen is one of my champion of change, but we have plenty of champions of change in our firm across Canada in every areas of law that to deal with this ESG issue.
All right, thank you. So I'd like to offer a very, very big thank you to Radha and Stephen, our speakers today. Also to our audience for dialing in. Thank you for the questions. And on behalf of MONDAC, the Canadian Corporate Counsel Association, and of Bennett Jones, thanks for joining us and have a great day. Thank you.
Thank you, Tim. Thank you, Stephen.